Time now to take a look at some of the notable calls that are out there, changes to analyst ratings and target prices. Let's start with one of the rail giants in Canada. Susquehanna has upgraded shares of Canadian Pacific Kansas City to positive from neutral, but at the same time has lowered the price target by $2 US to $92 US. There you see the stock at $78.40 currently. The analyst says the recent weakness in the shares is caused by cross-border regulatory fears as markets are weighing in on the prospects of Donald Trump to win the election. However, this near-term risk creates a long-term opportunity, Susquehanna says, to own the stock. The analyst calls the story the best growth story in the rails at a fair price. Another notable call is on the Canadian artificial intelligence play Celestica. That stock's moving in a big way today. RBC Capital Markets has raised its price target on Celestica to $75 US. That's up from 65, and you can see the stock is at 66 and change right now. The brokerage, RBC Capital Markets, keeps an outperform rating on the stock. The analyst says the company delivered another solid earnings beat, and even though its revenue forecast was in line with expectations, the analyst does see further upside, adding that long-term growth and profitability should drive the valuation on the stock higher. There are 10 analysts who cover Celestica. Of those 10, 9 say buy, 1 says hold, and there are no sell recommendations. And we'll also zero in on Shopify, the Canadian tech bellwether and online retailing giant. Scotiabank has introduced a price target on Shopify, or has increased its price target on Shopify by $5 US to $80 US. There's the TSX price at 110. There's the US price at 79.80. So the price target at Scotia has been bumped up, but is very much in line with where we are right now, and that would make sense of the sector perform rating that Scotia does have on the stock. The analyst at Scotia sees opportunities for both top and bottom line beats to consensus. While the stock is rated at sector perform, the analyst does expect to see further momentum due to Shopify's ability to drive strong upside in its results. Notable calls. Well, we've talked about Teck Resources a couple of times in passing today. Let's have a more detailed discussion on what many consider to be the bellwether Canadian mining stock in the base metal sector. It's down by more than 6% today, despite a profit beat in its third quarter. Let's talk to Dalton Baretto, Managing Director at Canaccord Genuity. Dalton, thanks a lot for joining us. Let's talk about the results before we get into the market reaction. The company reported, I believe, earnings per share and sales that were ahead of expectations. Is that correct?
That is correct, yeah. But those numbers hide a number of nuances, and that's what the market is focused on this morning.
Tell us about those nuances.
Yeah, so the actual EPS beat itself was, it was driven by a number of non-operating items. Things like the tax shield on a big write-down they took on their Trail smelter in BC as an example. What the market's really been focused on is the underlying operating performance. And, a big piece of that is this QB2 copper mine that they just spent almost $9 billion building in Chile. This mine is now, almost close to 2 years into its ramp up, and it continues to have challenges ramping up. It's still only at about 75% or so of design capacity. And, quarter after quarter, management continues to update us in terms of what's happening, but it seems to have hit a little bit of a plateau there. They've cut their copper production guidance for this year as well as for next year, which is a little bit of an unusual move this early on. And the market really seems to be zeroed in on that, given how much money they've spent, and how that this mine is supposed to be sort of the flagship of the portfolio on a go-forward basis. How
close is QB2 to achieving peak production levels?
It's still a little bit of a ways away. I'd say, on average, it's running at about 75% or so of where it needs to be.
What about copper pricing? We've seen copper prices run up recently. These were results that took us through to the end of September. How much of a positive were copper prices in the quarter for Teck?
On a go-forward basis, they're actually very meaningful. Your listeners would know that they've sold their coal business. That transaction closed in July. And so this is very much a copper, as well as a zinc company on a go-forward basis. And, copper gets a lot of airtime in terms of sort of market sentiment, just given its role in the energy transition and so on. But zinc pricing has actually increased dramatically this year as well on the back of a number of supply disruptions. So Teck is now very much leveraged to copper and zinc, which is why we've maintained our buy rating on the stock.
And of course, a big reason for the company's exit from the metallurgical coal business was to have the market's attention focused on copper and zinc and the importance of those metals in the energy transition. Do you expect a re-rating of the stock as the market gets accustomed to this company as a pure play on those two base metals?
A lot of that re-rating in terms of the company's multiples has happened already. I mean, this transaction has been expected for some time now. I think what you're going to see on a go-forward basis, though, is the market start to price in full operating rates at QB2 as that mine approaches design capacity over the next 12 months.
The company mentions the fact that it like many oil and gas producers in Canada, is returning capital to shareholders, $1.3 billion so far this year, while also reducing debt. Is that an important part of the story here? Is it meaningful to the shares, the strategy of reducing debt and returning capital?
Absolutely. At least in the near term, over the next kind of 6 to 12 months or so, they've committed to returning 3.5 billion Canadian dollars back to shareholders. A lot of that is proceeds from the sale of the coal business. They've also reduced $1.5 billion US in debt just over the last quarter alone.
Can the company do that? I assume it can, but how does the company do that at the same time while significantly expanding production, including in Chile?
Well, a lot of the construction, in fact, almost all of the construction capex is behind them already, and their next suite of projects is, not on deck for a couple of years. And a lot of those projects are much smaller in terms of capital requirements. In addition, they just sold 77% of their stake in the coal business to Glencore. That closed in July, and that netted them almost $7 million US. So they closed Q3 with nearly $12 billion in Canadian in terms of free liquidity.
You've got a buy rating on the shares and a price target of $80 Canadian. We can bring the stock back up again. It's trading at about 64 right now. Tell us how you get to that target price and that rating.
Absolutely. So that rating and target price is entirely predicated on QB2 achieving design capacity by this time next year. That will be very meaningful to the company's cash flows because it'll take Teck's copper production up to almost 600,000 tons a year.